Have you ever wondered why the prices of cryptocurrencies like Bitcoin can change so fast? It's a lot like the stock market. Big events happening around the world can make investors feel nervous or excited, and those feelings can cause prices to go up or down very quickly. When there is good news, like a big company deciding to use crypto, people get confident and buy more, which pushes the price up. But when there is bad news, like political problems or conflicts between countries, investors often get scared. They might worry about the global economy and decide to sell their assets to hold on to cash, which they see as safer. This is often called a risk-off mood. This past week, we saw a perfect example of this. Tensions between the United States and Iran suddenly got much worse. News of US airstrikes on Iranian nuclear sites on June 21st sent a wave of fear across all financial markets, and crypto was hit especially hard. When investors panic, they sell. This massive sell-off caused prices to drop sharply because there were suddenly many more sellers than buyers. In just one day, over $1 billion was lost by traders who had bet that prices would go up. It shows just how connected the crypto world is to global events, even though it's a digital and decentralized system. It's important for anyone new to crypto to understand this connection. Unlike a simple savings account, the value of your crypto can swing wildly based on headlines from the other side of the world. These geopolitical events create uncertainty, and uncertainty is something that most investors do not like. They prefer to know what might happen next. When they can't predict the future, they often play it safe by selling assets that are seen as risky, and cryptocurrency is still considered a high-risk investment by many. This is why staying informed about world news is almost as important as watching the crypto charts. So, when we talk about the crypto market being volatile, this is a big part of what we mean. It's not just about technology or new coin launches. It's also about human emotion and how people react to global stability or instability. The recent conflict was a stress test for the market, showing us how quickly sentiment can change from positive to negative. This fear spread like wildfire, causing a domino effect where falling prices triggered even more selling. Understanding this helps explain why the market looks the way it does today and prepares you for the ups and downs that are a normal part of investing in this space. The biggest names in crypto, Bitcoin, and Ethereum felt the heat from these global tensions more than any others. Bitcoin, the king of cryptocurrencies, experienced a dramatic price drop. For the first time in over a month, its price fell below the very important $100,000 level. It even touched lows around $99,000, which was a big shock to many who had gotten used to seeing it trade comfortably above six figures. This sudden dip below a major psychological number caused a lot of panic selling, as some investors feared the price could fall even further. It was a clear sign that the market was in a state of fear. Ethereum, the second largest cryptocurrency, also saw its value fall significantly. Its price dropped by nearly 10%, falling below the $2,200 mark. Just like with Bitcoin, this was a major move downwards that broke through important price levels that traders had been watching. For many people who hold Ethereum, seeing it lose so much value so quickly was a cause for concern. These price drops for both Bitcoin and Ethereum show that even the most established and well-known cryptocurrencies are not immune to market-wide panic. When big investors decide to sell, they often start with the largest assets they hold. What makes these drops so significant is the speed at which they happened. The fall was not a slow and steady decline. It was a rapid plunge that caught many traders off guard. This is what led to the massive liquidations we heard about, where over 240,000 traders lost their money because the market moved against them too fast. Most of these traders were using leverage, which means they were borrowing money to make bigger bets. When the price dropped suddenly, their positions were automatically closed, adding even more selling pressure to the market and pushing prices down even more. Right now, Bitcoin is trying to hold on to the $100,000 level, which has now become a battleground between buyers and sellers. Ethereum is similarly fighting to stay above its recent lows, around $2,200. Traders are watching these levels very closely. If the prices can stay above these marks, it might signal that the worst of the selling is over. However, if they fall further, it could mean more pain is ahead for the market. The next few days will be critical in showing us whether this was just a quick dip or the beginning of a longer downward trend. While many small investors were selling in a panic, something very interesting was happening behind the scenes. Some of the largest companies and institutional investors were doing the exact opposite. They were buying. This strategy is famously known as buying the dip. It means purchasing an asset when its price has dropped because you believe it will be worth much more in the long run. These big players, often called whales because of the size of their trades, see these moments of fear as a golden opportunity to get more Bitcoin at a discount. They're not worried about the short-term price swings caused by news headlines. For example, MicroStrategy, a company famous for its massive Bitcoin holdings, bought another 1,500 BTC. Another company, Japan's Metaplanet Inc., also added over 1,000 BTC to its treasury. These are not small purchases. They represent a strong belief that Bitcoin's value will eventually recover and climb to new highs. What's even more telling is that even before this dip, big companies were buying up Bitcoin faster than it was being created. Last week, public companies bought over 12,000 BTC, while miners only produced about 3,150 BTC. This creates a supply shortage, which could push prices up in the future. So why would these smart, experienced investors buy when everyone else is selling? It's because they have a long-term vision. They are not trading for a quick profit next week or next month. They are investing for the next several years. They believe that Bitcoin is a revolutionary technology and a powerful store of value, similar to digital gold. In their view, global political instability and economic uncertainty actually make Bitcoin more attractive over time. They see it as a safe haven asset that is separate from traditional government-controlled financial systems, which might face their own problems during a crisis. This institutional buying provides a strong level of support for the market. It can help stop the price from falling too far, as these large buy orders absorb the selling pressure from panicked retail investors. It also sends a powerful signal of confidence to the rest of the market. When everyday investors see that the biggest and wealthiest players are accumulating, not selling, it can help calm fears and encourage them to hold on or even buy more themselves. This tug-of-war between the scared short-term sellers and the confident long-term buyers is what defines the market during a crash. While Bitcoin and Ethereum get most of the attention, other cryptocurrencies known as altcoins also went on a wild ride. Coins like Solana, XRP, and even the popular meme coin Dogecoin saw their prices drop sharply during the initial panic. Solana, for instance, fell to around $128. However, just as quickly, some of these altcoins have started to show signs of a small recovery. Dogecoin, for example, bounced back from its lows, which shows that some traders are quick to jump back in, hoping to catch the bottom. But overall, Bitcoin has been performing better than most altcoins recently. It's also a tense time for security in the crypto world. We've seen a few troubling incidents recently that remind us to always be careful. A platform called Hack and Bridge was exploited, leading to a loss of about $250,000. Even the popular crypto news site Cointelegraph was briefly compromised, showing a fake pop-up to trick users. On a larger scale, US authorities took action against a massive $225 million crypto money laundering ring linked to scams in Southeast Asia. These events are a stark reminder that while the technology is exciting, there are still risks from hackers and scammers that everyone needs to be aware of. Looking ahead, the market is filled with uncertainty. The geopolitical situation remains tense, and nobody knows for sure what will happen next. This means we can probably expect prices to continue bouncing up and down with high volatility. However, many expert analysts are not entirely pessimistic. They see the current situation as a major wealth transfer, where impatient investors are selling their crypto at a loss to large, patient institutions that are accumulating for the long term. This buying the dip by big players is seen as a very positive sign for the future. So what does this all mean for someone new to crypto? It means that this is a time for caution, learning, and patience. The market is being tested, and its reaction to world events shows that it is still maturing. While the drops can be scary, the strong buying from major institutions suggests that the long-term belief in cryptocurrency remains intact. Many experts believe this period of fear and consolidation is simply setting the stage for the next major bull run. For now, the best approach is to stay informed, not panic, and understand that volatility is just part of the crypto journey.